Hey, everybody. Before we jump into today's episode, I just want to point out a few ways in which you can work with us here at How to SaaS. Number one, if you're an investor and you're in the middle of a transaction and you want to figure out what is the marketing potential of the target investment that I'm looking at, you can engage with us in a due diligence engagement where within 2 weeks, we can give you a very clear picture of all the levers within the marketing function of that organization for them to drive more revenue and pipeline for the business while being incredibly efficient. Number two, if you're the founder, CEO, operator, or investor of a company where marketing is just under leveraged and it's seen as a growth lever that requires more investment, we can come in and do a deep dive across 3 to 4 months and analyze all the opportunities within that business on the marketing side by looking at demand gen, paid media, account-based marketing, content marketing, product marketing, SEO, website, and much more, and come back with a set of recommendations and a roadmap for what marketing needs to execute against to drive more enterprise value for that business. And number three, if you're the CEO of a company that doesn't have a CMO right now, or there's a gap in the organization because the VP of marketing or CMO was recently transitioned out, we can come in a fractional CMO capacity and partner with you on that business and lead the internal team and the operational plan so that the marketing function continues to make progress and drive more pipeline and revenue. And we'll also help you hire your next CMO by being part of that hiring process and onboard that new person once they're ready to join the organization so that they get a running start. These three types of engagements are some of the most common ways in which investors, CEOs, and companies work with us. And we have a proven track record of driving a ton of enterprise value and revenue growth across those companies. To learn more, go to www.howtosas.com, where you'll get a lot more information in terms of the types of engagements I've described. And you can see case studies and other examples of the work that we've done, so you have a lot more confidence in partnering with us. And with that said, let's get to the episode. Enjoy the show. Welcome to the Private Equity Value Creation Podcast, where we interview leading investors, operators, bankers, and advisors to help you answer one question: how do we increase the enterprise value of our companies? My name is Shiv Narayanan, and each episode I will dive deep with a guest to help you become a better value creator and capital allocator. So with that said, let's jump right in and let's get started with today's episode. My guest today is Ed Byrne, and he is a partner at Scaleworks. And what's really interesting about their model is that they call it venture equity, which is different than the traditional private equity model and different than the venture capital model. And what I really liked about the conversation with Ed is that he encourages founders to build slower, raise lesser capital up front so that you are focused on the fundamentals of the business, like profitability, like cash flow, using those as constraints to figure out what to build and grow the business profitably over time, and then raise capital slowly or later on in the cycle so that you have the right type of partner. And then Ed also went into how they help increase the value of their portfolio companies once they make their investments, and especially their model of building their teams in-house at their headquarters in San Antonio. And I think it's a little bit different than a lot of the operating teams and operating partner model that other private equity firms use. And I think what's great about the way Scaleworks is doing it is that they're able to build a ton of this expertise in-house that is actually working directly with their portfolio companies instead of more of this shared services model that is more traditional inside other private equity firms. So I thought there was a lot of interesting takeaways, and it may not apply to you directly, but I think for your particular firm, as you're thinking about how to leverage operating teams, there's going to be a lot of great takeaways from that as well. So with that said, I'll leave you to it. Enjoy the episode. All right, Ed, welcome to the show. How's it going?
Great. Thanks for having me.
Yeah, excited to have you on. So why don't we start with your background in Scaleworks, and then let's take it from there.
Sure. Scaleworks, I'm here. We set this up 10 years ago, almost to the day. So I guess it's our decade anniversary on our first fund is just basically finished. We're on our third fund now. I can go to Scaleworks in a few minutes, but before this, I'm Irish, as someone will get from my accent. I live in San Antonio now. I was in Santa Barbara for 2 years before this, doing a kind of a test fund or a smaller fund. And then I joined my business partner, Lou Moorman here. We set Scaleworks up. Prior to that, I was a software entrepreneur. And when we talk about venture equity and what Scaleworks does, the lessons I learned from being an entrepreneur and screwing up my own company and realizing what the downsides of VC are and the downsides of as a friend of mine calls it, featureitis, which I'm happy to talk about later too. So a lot of lessons learned for me is what led into Scaleworks.
And it's funny, yeah. The VC is something that people historically have thought is a great investment vehicle, and a lot of companies celebrate raising a bunch of capital. And then you have private equity, which is more about buying more proven businesses and kind of let it operate for EBITDA and cash flow with more limited growth. But one of the things that's unique about you guys is that you coined this term called venture equity. Talk a little bit more about that.
Well, let me start with on the VC part. I mean, I think certainly, 10 or so years ago, somehow software became the sexy thing to do, and SaaS as a result. And, pre-SaaS and pre-AWS, basically, to start a company, you have to raise millions of dollars in venture capital, hire software developers, spend 6, 12, 18 months developing software, then hire salespeople, bring it to market and try and sell it. Failure rate high, cost high, you have to get a data center to host the servers. Then AWS comes along, Google AdWords comes along, and so you can basically start a company for near zero, host it on Amazon for basically free, and you can build an MVP, test it with Google AdWords and see if it works. So the cost of starting a company exponentially reduced. But somehow the average seed round went up. So I can't really understand what happened there, that the number of dollars needed to build a business inversely rose with the cost of actually starting a business, or whatever disproportionately was correlated against it. And so, I think VC became I kind of blame TechCrunch for this. I think VC became a requirement along the path of being an entrepreneur. People said, okay, well, I raised my seed round, I raised $1 million, $5 million, whatever it is, and that was seen as an accolade. But, VC is just another form of debt. You sell your equity. And I think once you get on the VC treadmill, you get your 12 or 18 months burn. VCs have and I will say, look, we are, because of the companies we buy, I wouldn't say we're anti-VC, but we definitely see the downside of VC. And the downside being that, one, VCs love backing engineers as founders, as they should, right? Engineers have to build the business. And I have unbelievable respect for anyone that can build from 0 to 1. But it's a very rare, and there's a reason these founders are famous, but it's a very rare founder who can go from being a product builder to a business scaler. Not just a skill set, but in my experience, most product or engineering founders don't want to do that. They have no interest in go-to-market. They have no interest in the bureaucracy of hiring VPs and then having directors beneath them. And so because they have no interest, they don't build a skill set. And so VCs love funding them. VCs also, in my mind, have a portfolio theory where they're like, look, we don't want 2Xers, 3Xers. We want 10Xers, because they're saying, well, look, whatever, 5 out of 10 will go bust. 2 or 3 out of 10 will return 1 or 2X. And 1 out of 10 might get 3 or 4. We need 1 out of 10 to be a 10X plus, to make our fund mechanics work. But what happens then is software businesses or entrepreneurs who are not going to hit unicorn status, who are not, who are encouraged to shoot for the stars because they have their 18-month runway and encouraged to do unscalable and maybe inefficient things and scale maybe a day too early, shoot for the stars, don't get there, and end up, running out of gas and not being able to raise the next money, and maybe the business goes nowhere, and they get in the kind of death valley, or they just become a kind of zombie business. And that's how the VC world works. But there's lots of really good software businesses that could have made the entrepreneur decent money that just shouldn't have raised VC. And so my long-winded story here is that I think the vast majority of software businesses should not ever raise VC. It's the wrong treadmill to be on. It sets you up for an all or nothing, shoot for the stars or die trying mentality, which suits the VC because that's what they have to go for, but it does not suit the entrepreneur. And they so get a friends and family round, take advantage of the near zero cost to start, and build your business that way. And over, as an entrepreneur, owning 80 to 100% of your company, slow but consistent growth over 5 or 10 years can make you very successful and wealthy.
Totally. Yeah. I mean, I think that's well said. And I think a lot of companies have fallen into that trap. And it's also, every company is limited by the market that it's in, its own business model, the customers and what their needs are. Not every company can actually even become a $1 billion business or multi-$100 million company in and of itself. So by raising money in a certain way, you're almost like making that the odds of failure significantly higher. Even if you build, let's say, a $10 million business, like less than 1% of businesses ever get to 10 million, right? So to do that is a significant achievement, but in a VC driven world, like 10 million is nowhere near enough to generate the return that you need to generate for the capital that you've raised.
Look, I also think when you have money in the bank, you spend it. You're probably encouraged when you raise money because VCs don't want to give you a 10-year runway. And so, we like to say, we prefer to scale a day too late than a day too early. And we tend to come across businesses that they raise money, they scale a day too early. And there's no constraints when you have money in the bank. Your customers aren't paying for your staff or your build out. You're not prioritizing, where your budget dollar goes based on, whatever your operating income or operating margin is. And so, and I get it. If you're trying to grow, triple growth over a couple of years, you have to do these things, but it's an extremely risky path. Whereas if you were bounded by the normal constraints of any normal business that we've run for the last 100 years that isn't VC funded, the money comes in from customers and you decide how to allocate it. And I think those constraints are far healthier and create longer term businesses.
Totally. So talk about what is the counterfactual here with those constraints. Like, for example, we're a bootstrap company and I constantly have to make those trade-offs in running this business. And so I totally align with that. And I think more companies should be thinking about their revenue, their profit, their operating margin, their gross margin, all of these things that go into building a healthy business. So how should founders think about this, or how should investors think about a different way of funding companies?
Well, look, we all play to the market we're in. So VCs are probably going to keep doing what they do, and they probably should just fund less businesses. And maybe there's too many VCs out there right now, and that could be why the checks have gone up. And I think the tech crunchization of the world made VC so either attractive or seemingly the path. I think, look, if you're a founder, you should look and say, am I happy if this is going to be a $5, $10, $50 million business? Can I get there with a seed round? I would say yes, by the way. Most software businesses can today, especially B2B. And then if, like, you're a bootstrap business, if you decide you have a massive opportunity and you flat out need some money for it, okay, raise debt. There's loads of venture debt. And you don't need to give a warrant. You can pay a higher interest rate. If you're, look, like SaaS debt's expensive, maybe 15, 17%. But if you're looking at an opportunity you think is that good, well, the opportunity should be bringing in 20% more growth. Otherwise, just slowly get into it. So you can do, if you're very confident, raise a certain amount of venture debt and pay it back. You still own all your equity. It's expensive debt. It's way cheaper than VC because you still own your equity if it succeeds. And if it doesn't succeed and you have a solid business that's profitable, you'll pay off the debt. So I would, look, maybe I'm very conservative. I would be risk adjusted. If you own your own business, it's better to go a little slower and steadier and last it out and build lasting long-term value for you and your family or whatever shareholders you've got or partners than it is to risk it all. Because if you don't have a portfolio, risking it all, I think, I don't know. To me, it's hard to justify ever doing that.
So just to play devil's advocate, doesn't the debt side lever up the business in the early days too much? Like, how do you perceive that? Because debt still needs to be serviced. There's covenants sometimes. Like, how do you manage that as a founder? Because venture capital, yes, on the flip side, maybe you might raise too much money too quickly and spend all of it maybe too early. With debt, you kind of are way more accountable in some ways to service the debt, and that can also kind of bog down companies. So how do you look at that?
Look, I love the challenge. I didn't say take on debt too early. I wouldn't take on debt too early. I'm all for a friends and family round. I think several $1 million you can raise from angels. That's enough to get going. You can probably buy them out later on when you're successful. Their expectations are different. They're not on your board. So I think a friends and family round, I'm for it. You need to do that. I wouldn't raise debt on day two. I think you should get to, like, you're a bootstrap business. Let's say you're doing 5 million revenue. That's enough that you can take on $1 million in debt. Like, pick a very sensible number. I would never over lever the business. If you take on debt that you're like, if this doesn't work, it's game over for me, don't do it. That's silly, right? Like, unless your confidence is through the roof. But then, of course, if you really believe it's risk adjusted low, do it. Or if you can afford to pay back the debt if it doesn't go according to plan, do it. But and look, this sounds very conservative, but I'm thinking about people who own their own business, who have a long-term view, who may never start another business. This is their idea. They're happy to do 10 years at it, or maybe they're happy to sell it when it gets to a couple of million in EBITDA. And if you own all the equity, that's a very meaningful return if you don't already have a full bank account. So, you've already taken the big risk of starting a business and bootstrapping your way, or basically bootstrapping after your friends and family around, to some success. Don't risk it all. So I do think debt is a better option than VC for a bootstrap business that's looking for, a reasonable growth opportunity, not an exponential VC growth opportunity. But I absolutely wouldn't say take that too early.
Mm-hmm, mm-hmm. And so talk about the venture equity model. Like, how does that fit in, and what is the timing of that? Like, how should founders think about leveraging that instead of, let's say, going the VC route?
Well, I mean, look, we call it venture equity, and my partner Lou coined this probably 10 odd years ago, in that we're not private equity. So I think of private equity as acquiring the business, leveraging tons of debt, using the business's EBITDA to pay the debt off, and definitely on accelerating growth. So we're not that. And I think a VC, as what I've already said, in terms of how VCs have a portfolio view and shift from the startup mentality, we feel like we're in the middle. We are acquirers, not investors, right? So we want to have a majority of the business. We we tend not to have any other investor partners. Like we'd like to get as close to 100% of it as we can. So from a founder's point of view, I wouldn't generally, we've broken these rules, but generally we wouldn't consider ourselves investors in the business. The founder can ride along with us, but generally we would consider ourselves owners, owner operators. And then we call it venture equity because we feel like we're in the middle of, our goal is absolutely laser focused on growth. We're not trying to maximize EBITDA. We say, look, I've already said we prefer to scale a day too late than a day too early, but we look at our CEOs and say, certainly in the growth phase, if you're making EBITDA, because we're not trying to sell the businesses early on, you don't know how to grow the business, right? We want to reinvest every dollar, and if there's profitable ways to reinvest beyond that, we can put some debt in or additional equity into the business. But we look at venture equity as kind of the hybrid. We're not private equity. We put low to no debt on any of our businesses. We're not debt people. We are hyper focused on growth, just not growth at all costs, which is why we don't consider ourselves VC.
Got it. So you're still buying a majority of the business.
Yeah, that's the closer to private equity side of the house.
We'll get back to the show in just a moment, but before we do, one of the most common and important value creation levers that we hear about on the show from private equity investors and our own PE partners is go-to-market. Yet, when these same PE partners bring us into their portfolio companies or new target investments that they're exploring, we find that the marketing function is quite immature, underutilized, and under-optimized. And so that's a huge opportunity that we see inside these companies. And if you have a portfolio company that you feel like could scale a lot faster to drive more pipeline and revenue, or you're looking at a new investment where you feel like that could be core to your investment thesis, well, we'd love to explore that with you and figure out how we can partner with you to drive more enterprise value creation on the marketing side, similar to the way that we've done with major PE firms like TA, Updata, HG, STG, and many more. At this point, we've done hundreds of engagements across hundreds of industries and verticals, and we have a ton of benchmarks and frameworks that we bring to these engagements to help you drive as much enterprise value as quickly as possible. So if that sounds like something that you might be interested in, you can just email me directly at shiv@howtosas.com or go to our website and schedule a demo, and we'd love to speak with you about it further. And now with that said, let's get back to the show. And so walk us through that model. So let's say a business is doing 10 million in revenue. How does your model differ? I get it that a PE firm will use a ton of debt, finance the acquisition, maybe it's 80-20, and then they're using EBITDA to pay it off. How do you guys structure the deal, and how do you look at your value creation plan and also your exit path and the returns on that?
Yep, I can look at all those things. So we generally look at businesses doing 5 to 10 million. So first of all, there's not really much of a market. Certainly when we started this, there was very little market because below 10 million, larger funds are just not interested. It's too much risk and work, right? I remember talking to a guy early on in a big PE fund who told me, you don't want to spend the money to do the work. And I laughed. I was like, oh shit, I think we got our model all wrong. Because, we do the work. We generally bring in a new CEO, right? Because if we consider ourselves, we change agents, we buy businesses that have great products from product-led founders. They have a solid top of funnel. They have a customer base who likes the product, but they're not sophisticated in go-to-market. Either they're not interested, they've lost, they've been in their business 10 years and either don't want to acquire the skills or are burnt out looking at trying to raise money or whatever they're trying. Maybe their cap table is a little bit aged out in terms of who's on it. But so we're buying between 5 and 10 million. There's not a huge market of buyers necessarily. So hopefully we get, and we're not buying businesses that are growing 50, 100%. We're buying businesses that, like I said, great product, great fundamentals, but look, generally lacking sophistication or interest on go-to-market. And that's where we feel like, look, our name's Scaleworks. So we like to come in and help to scale the business. And so our kind of theory, or where we think we create value, is we buy these, product-focused businesses that have good core fundamentals. And then we try and accelerate the growth. So we bring in a new CEO. We've a 20,000 square foot office here in San Antonio. We build the go-to-market team here. Right? We'll keep the product team. We're buying the product that we love, but we build, and then we try and put good fundamentals around increasing retention, accelerating go-to-market, professionalizing the funnel, if you want to call it that, and accelerating growth. And then, I don't like to think we have a timeline, because I think if you have a timeline on exit, you're selling the business. And I think the best exits are when your business is bought, not sold. And so for whatever reason, tends to be about 5 years. We've had businesses for 2 or 3. We've had some for 7. I think, if the business is doing well, it will get acquired. And so I way prefer to have businesses where the door is being kicked down on someone else's timeline rather than mine. You get a better return when someone else wants to buy your business. But it's tended to be about, I'd say 5 years is a good average.
That's interesting. So you're saying you're hiring the CEO and they're working at your firm's office in San Antonio, and the go-to-market team is being built there. Did I hear that correctly?
Yeah. Because look, when we buy businesses, we're not buying businesses that have awesome go-to-market and are scaling fast and doing great. I mean, look, the reality is we're value buyers. So, we're not turnaround people. Warren Buffett straight line turnarounds rarely turn around. We're the accelerator phrase got bastardized years ago with these accelerators, which are basically incubators, but we are an accelerator, right? So we want to buy a business doing 10 to 30% growth, let's say, where we see great fundamentals, but clear lack of execution on the go-to-market side. That generally means low to no team on that side. And so we'll bring in a CEO. I think if you don't bring in a new CEO as an owner, you can't really call yourself a change agent. If you say, you're a value-added investor and you fly to turn up to a board once a quarter, I just think that's bullshit. Right? So we hire a new CEO here in San Antonio. The founder can stay on board if they want to, right? As often they might want to say as VP of product or CTO. That happens rarely. It does happen, because when someone sells their baby, they tend to want someone else to take control, or be happy for someone to do that. And so we hire a new CEO. Then we generally hire VP marketing, VP sales, build out the go-to-market team. If there's some superstars on the team, we keep them, of course. But generally, there's just businesses in that zone, the $5 to $10 million zone that are in that growth clip. The go-to-market team is just borderline non-existent. And so we build it out, and then replacement and growth hires are done here in San Antonio. So over a 2 or 3 year period, and we're big in-office believers, because I think when you're in change mode, the ability to scrap together on a whiteboard matters. I think, coasting is one thing, but when you're changing a business, I think you can't replicate in person. And so over a 2 or 3 year period, the HQ ends up being San Antonio.
Interesting. So when you first acquire the business, it might still be that the product teams are elsewhere, but over time, you're bringing these companies to your central hub in San Antonio.
I'd say the product teams, look, we're not private equity. We don't lever loads of debt, and we don't do loads of layoffs, right? Because we're growth focused. So you can't do layoffs and we're growth focused. And so the product team, look, we want to keep whoever wants to be here. And so I would say, if I think about our businesses 5 years later, there's still always a few people who want to stay with the business, often on the product side or on the engineering side. The CS side, look, whoever wants to stay. It just turns out as you grow, if we buy a business with 30 employees, probably 5 years later, all going well, there's 80 employees. So, just by nature, let's say there's 30% attrition, so now there's 20 of the original 30. So that's basically a quarter of the business outside of San Antonio.
Right. It's really interesting because a lot of PE firms have operating partners and operating teams that they keep central, but then the go-to-market teams for their companies are within the businesses. But what's interesting about this is, one, you're buying these companies that don't have the go-to-market sophistication, and then you're building the team at your office. So it's almost like they're working at the company, but it's almost like your operating team model is through the business in and of itself, and that's your expertise. And in a way, it's a differentiator to create value inside these companies.
Yeah, I take that. I'd probably say that slightly differently. So we don't believe in the operating partner model, which is basically a shared service. And we tried it early on. And, playbook is another word for it. And I just, CEOs don't want all that help. So, and so I think there's always, the PE firms think they're adding loads of value, and maybe they are. And the CEOs tolerate it and think they add a value without them. And so who knows what the true answer is. But when we tried having a playbook, I think, look, the upside is, I always think of the two models, right? So the Amazon model and the Google model. The Google model is, you come in as an engineer, you spend 6 months learning Go and the Google systems, and you can be deployed on any product, the standardized system everywhere. And I see the benefit of that. And I call that the PE operating model, where, as you say, you have operating teams centralized, you get involved in the business. On the other side then is the Amazon and Berkshire model, where you let everything run independently. Amazon teams might be building the same product in different countries and competing using any systems they want. And so I think that is a much more capitalism favorable model, where the best idea raises. Okay, you lose some efficiencies. Okay, you can't move people across. Okay, you don't get synergies. Okay, you don't get to build a playbook. But the best ideas emerge. We do CEO get-togethers every quarter, so we can share best practices. We don't force any synergies on anyone. And so I think I think the idea of shared services is far better, at least in my experience, than the reality. Um, and so having everyone central means we get to talk to them all the time, and we can help in a kind of coaching and advising role, and everyone together. So, they're all our VPs of marketing here, they can get together. But whenever we try to force a shared service or a playbook, I think we probably got the lowest common denominator, not the best outcome.
Yeah, I think shared services would imply that the same resources are working on all the companies, but in this case you're building dedicated teams for those businesses, but it's just in a centralized location. But I think the interesting thing about that is it's a slightly different approach to resourcing out inside these companies, right? Because people have these distributed teams and distributed port codes, and then they try to manage it with their centralized ops teams, and then it kind of creates this duplication and overlap, and then there's some politics, and not everybody's always willing to take the help, or operating partners think they're helping, and then CEOs resist it or CMOs are resisting it. So kind of there's this ongoing tension. But with this model, it feels like there would be far less friction.
Yeah, far less. I mean, look, I think the jury is out on what's the better model. I mean, our models worked well for us, but the other models worked really well for other funds too, enviable funds. So I, my gut feel is at our size, it's better to build independently and try and share learnings as opposed to force shared services. But look, I could be persuaded in other ways. This is the way we've done it, and from I guess it was early on we just realized when we tried playbook and shared services, the resistance was high. So there's always going to be resistance to any ideas we have, even in a chairman role. So the goal is persuasion and soft power as often as possible.
Yeah. You mentioned, there's this resistance to this idea of having a playbook, but given that all the teams are centralized, like I would imagine, and the types of companies that you're investing in, I would imagine there is a lot of overlap in the types of work that these companies need to do. So how do you look at that and cross-pollination? And also, like, what are some of the biggest areas that you see that these companies actually do need help on?
Well, it's the first part in terms of cross-pollination. Like, look, SaaS is SaaS, or business is business. And so I think if you walked around the office, I mean, we've a unique enough space here that every company has its own dedicated office. So there's no shared, it's a shared building, but it's not an open space. And so if you walked around, we like to say that the CEOs build the culture. We have nothing to do with the culture. But Scaleworks sets the principles. And one of the principles I will see you through is in-person work here in San Antonio. So as far as cross-pollination, you hope there's some osmosis from people being in the building, and you hope we can facilitate some by doing CEO workshops, and you hope some of the VPs of the various disciplines will do that too. But again, when we force that, people turn up because they have to, but not because they're really engaged. So you hope there's some osmosis, and some of that happened informally. Formally, just felt harder.
What are some of the biggest areas that you see that these companies need help? Like go-to-market, obviously, you're saying is immature, but go-to-market is such an expansive area. So when you come in and you're buying these companies, you probably identify immediate areas that need to be addressed. So what are some of the biggest areas that you think are adding the most value to these companies?
Look, we have a scorecard when we're in diligence on a business, or when we're about to do an LOI and make an offer on a company. And other than the kind of, validating factors, we like to see some low-hanging fruit. I don't oversimplify and say, it's around go-to-market, and you're right, go-to-market is expansive, but, we like to see things that maybe the CS team isn't incentivized on upselling or retention. I think founders often don't pay enough attention to usage metrics of their product, and they don't keep themselves, especially product builders, don't keep themselves honest on, are the features they're building being used? You rarely see anyone prune features that they built a year ago and no one is using. And so, one, every new build should be stack ranked by, cost and impact and timeline. And then two, I think, we have a little one-page metrics sheet, which just focuses, we like, common sense is our most used phrase around here, but just looking at the core metrics, the leading indicators, as opposed to the lagging indicators. The leading indicator, it could be, we own a search business. The leading indicator is how many searches is there per month. And we say, well, look, if we can increase the number of searches per month, it logically follows that revenue will increase later on, and we should do things along the way. And so joining the dots between, well, you turn the lever up here and the lever down here and the lever down here. And, oh, that's not 1, 2, 3. That's actually 3 by 3, right? Because it compounds at each stage. And so I think, I'm trying to get away from the vagueness of it, but if you're not well instrumented in the business, and then you're not looking at the kind of go-to-market or general kind of common sense business tactics at each layer of the business, I think that creates opportunity for, look, if you buy off a founder who's running for 5 or 10 years and isn't a professional business person, like they're a professional product builder, they probably aren't instrumental. They're not looking at all these levers. And then when you bring a new CEO in, look, they're going to break some stuff because we will make mistakes that the founder has already tried and failed at. We'll also, try things the founder already tried and do it differently and succeed in. And so there is a fresh set of eyes or fresh owner perspective and our focus, because I think, look, as a previous founder myself, product passion actually has a very dangerous downside, because I will build the product I want, and that can work, and you can have unbelievable successes when I build the product to market. I build it for myself, and it turns out the market wants it, but it's very hard then to take customer feedback and to do true user interviews. Right? I've heard founders do many user interviews where they basically lead the witness, and they tell the user what they're going to build, and they get them excited, and it's a sales pitch, not an interview. So it's very hard to be dispassionate about your own product. It's not hard for us to be dispassionate. Like, I'm passionate about business, right? I think, like, looking at ideas on how to grow the business, how to change the strategy, how to change the category, how to reposition, how should we build out this? Where should we spend our money? Is this going to be like, should we move up market or down market? Is this, do we publish the pricing online? What are the levers of pricing? Do we make it per seat? There's so many levers that I can get passionate about. The product isn't the one I need to be passionate about. Someone was already passionate about the product to get it to 5 or 10 million revenue. And so I actually think a superpower is a new team or new leader. I'm not saying the founder has to go, but who takes a dispassionate product view and can ring a customer and go, hey, what do you like about it? Why would you buy it? What features do you use? And that sounds so simple, but I guarantee when a founder does that and the user says, well, I don't use this or I do use this, the founder says, hang on, did you know you could do this? We can change the feature that way. We can add those. Should we build this for you? Whereas a dispassionate product person, but someone super focused on the business, I think asks a whole different set of questions, because their goal is genuinely learning what the user wants and then delivering it so they can increase revenue or increase retention. So I think it's a fundamentally different approach, and I think it's unbelievably difficult for a founder to truly take that dispassionate view.
Yeah, no, I completely agree with that. Well, I guess as you're coming in, you mentioned product, and that's like a whole other area as well. So, and especially given these companies are 5 to 10 million, they're still finding their way, right? They probably have product market fit, good retention, and all of those things, but they probably haven't nailed down exactly which verticals or industries have their best fit customers, or they have the best retention. They probably don't have the best product marketing. So like, it feels like an expansive ocean of things to do. So how are you prioritizing that and figuring out what are the biggest levers to pull in a business of that size, whether it's product, pricing, sales efficiency, marketing campaigns? Like, how are you prioritizing those areas?
Well, like, look, one part of it is, as a CEO, you fight the biggest buyers. So you go wherever the biggest buyers are, or biggest opportunities, right? So there's always going to be stuff to do everywhere. And then I love when you talk about, founders don't know what categories to go in. We tend to find businesses, and I think, it's a generalization, but they try and boil the ocean, and they want to be all things to all people. And so one of the things we do, which again is so difficult for a founder, is to narrow it down. And so, Peter Thiel saying it would be a monopoly. We're like, look, you're trying to sell to so many different areas. You're right. You maybe have an instrumental business to figure out what your ICP is. And so we like to do, I think it's on our website, one of our principles is category specialization, narrow the category down. And so I fought this with every business we've ever bought, of narrow it down, put it on your website. We sell this product to this type of user. And every time it's like, well, what about all our other customers that do this and do that? I'm like, look, if you win in that TAM, and like the TAM of whatever we're specializing in is probably 100 million or 500 million or more. So, and we want to be number one in that small subcategory. And I say to the CEOs, look, if you win in that, first of all, that'll be a champagne day. Let's have champagne. And then we can go and expand into other categories. But if you don't specialize and you're small, you're like, I remember talking to a founder years ago who told me he had to have the best product with the most features at the cheapest price. And I was like, look, that, even if that was possible, which I don't think it is, but even if possible, the market wouldn't believe you, right? It's like, right. If Gucci said they were the best bag, but it's only $5, he said, I just don't believe it. I don't believe I can get quality and cheapness. And so pricing is a signal. And I would say, look, I think the flat out absolute most underutilized lever in business is pricing. I think founders especially, but not just founders, CEOs too. And it's probably somewhat of the reverse of the VC portfolio theory, which I don't love, but maybe we can take this portfolio view, is founders and CEOs live in fear of changing the price. And changing the price generally means a price increase. And so I look and say, look, if your business in the last year has not matured, improved, added features, deepened the value it brings to customers, first of all, you're going backwards. So let's assume you're increasing value to your customers and to the market, and you're not increasing the price. Like if you're adding more value, if you're not, the business is dead anyway. If you're adding more value, you have to increase the price. And it's not just about it's not about a price increase. It's not about like, I'm Slack and I just double the price overnight for no reason. I think they might get high churn from that. But if you truly, especially when you're a small business, if you're iterating fast and adding value, and if there's subsets of customers you're not adding value to, look, don't increase the price there and you're probably going to lose them anyway. But for your core customer set, and as your business matures and changes, which it definitely does, it just amazes me how much people live in fear of value pricing, right? And look, and then the other one, if you get someone to consider value pricing, they talk about grandfathering. I think grandfathering is making new customers subsidize old customers. That's not fair. If the old customer doesn't value the business for the value you're providing today, it might not be the right customer. And these are sacrifices you have to make. You want the right customers. I'm not trying to encourage massive churn, and I'm not saying you should do it overnight, but I do think right pricing, I don't think I've ever had a conversation with someone who disagrees with right pricing. But every business we look at, or almost every business, pricing is just a lever that people do not put in their quarterly or annual reviews. They do not talk about the pricing. It's set a few years ago. We build out, we build, we hire, we grow. And pricing is so rarely looked at. It breaks my brain. It's such a big lever.
Totally agree. And also pricing is one of those things that has one of the direct impacts on gross margin. And the higher gross margin is, the more of an impact you can make in every area. So completely agree with that. Beyond this, what about the people side, on the team side? Obviously, you're building the teams on the go-to-market side, but what about other leaders beyond the CEO and other transformations that you're making there?
I mean, look, the CEO is fundamentally the biggest change we make. This is again not being overly playbooked, right? I mean, of course, SaaS is SaaS, and so there's lots of pattern recognition. You hope that makes us, better at our job over time. But like I always say, finding the company to buy is way easier than finding the right CEO, like incalculably easier. It's, like the CEO determines everything in the business, especially when we're not an overly playbooked business, right? The CEO is not a puppet appointee who just has to get a folder and do it and do it the Scaleworks way, right? So, and every CEO is different. There's no prototypical CEO, VP of sales. I think you could probably write down on paper what the average VP of sales is going to be like, same for marketing or product, but CEOs can come from product marketing or sales backgrounds. So it's so difficult. And so I would say, look, I'd hate to, throw out some generalization about here's transformations you make and say, look, every business is the same in many ways, and every business has its different challenges in many ways. And so, generalizations, you got to figure out, category specialization. But, we want to help the CEO hire their leadership team. If we get the right CEO and we help them get the right leadership team, 99% of our job is done.
Mm-hmm.
But getting the right CEO is an unbelievably difficult challenge.
Part.
Yeah, absolutely. The right CEO, presuming we've bought well, which we've generally bought well, then the right CEO will make everything. And so, I think we're getting better at that, but we're not perfect. And I wish we were better, because the wrong CEO is so destructive to the business.
Yeah. What about on the side of actually eventually exiting? How do you look at that with these companies? Because you're buying them at such an earlier stage. Like, I would imagine with a lot of the work that you're doing in optimizations, they start to grow faster. So is your whole period still the traditional private equity where it's 5 to 7 years, or do you look at it differently?
Yeah, like I said earlier, I don't like having a timeline on it. It turns out to be, 5 to 7 years or 3 to 5 years. It just depends. But like, our goal, first of all, or our job, we get a pool of money, and our job is to give back a bigger pool of money. And it's a 10-year fund, but none of our investors have ever asked us to return faster. And, we still own a stake in the business, and it'll be year 11 soon. And so, but the fund has done well. And so I look at it as buy the business well, build a team, grow. Once you're in the teens or above in revenue, there is a bigger pool of buyers. Ideal world, I don't want to sell the business. I want the business to be bought. That doesn't mean when someone inbounds, we won't get a bank and then decide it's time to sell and, solicit more offers to get more of a competitive process. But I prefer it to be driven by inbound and realize it's right. Also, look, if we ask the management team, do they want to sell or not? And they say no, well, great, we can keep backing them to grow. And if they say yes, what are we going to say? No, we don't want to sell. So, it's not only up to us. And so, the average is 5 years, but I don't look at it in that timeline, like, of course it takes a year after you buy a business to hire a bit of a team and figure out what the hell you've got. And then it takes another year to have any kind of like, okay, you make a few mistakes, you do, to try and build your flywheel of growth. And then it takes another year or two to prove that. So yeah, it takes 3 years really to get any proven, and scaled value adds. But I don't look at it as like, okay, boom, we've done that, now let's sell it. So
Right. Right. No, that's great. I think that's a good note because we're coming up on time. But before we do, Ed, what's the best way if somebody's listening, if a founder is listening or another investor that wants to get in touch, what's the best way for them to get a hold of you?
and at scaleworks.com. Easy.
Okay, awesome. We'll be sure to include that in the show notes and your website and any other links that we can. And with that said, Ed, thanks for coming on and sharing your wisdom. I'm a big believer in a lot of the stuff that you said. I think a lot of founders can benefit from building slower, more sustainably without raising too much capital and focusing on some of the essential metrics. So appreciate you coming on and sharing that insight.
No, pleasure. Thank you.
Thanks for listening to today's episode. Before you take off, just a few requests from our side. Number one, if you haven't done so already, please subscribe to the podcast on iTunes or Spotify or YouTube or wherever you go to listen to your podcasts. Number two, if you are in the market for due diligence services, strategy consulting, or fractional CMO services, please get in touch with us at www.howtosaas.com. And third, please buy a copy of my new book, Exit Ready Marketing. It covers a ton of concepts that we take our customers through, private equity investors, B2B companies, CEOs, operating partners, and marketers. And there's a ton of great value in there that expands on my previous book, Post-Acquisition Marketing, as well. So with that said, I hope you enjoyed today's content, and we'll see you on the next episode.